Welcome to the market observations call for the week of October the 17th, 2022. I am your host, Eric Jefferson, managing partner with Trustbridge Capital. Before we get started here, just want to share a few quick words to keep the lawyers happy, and then we can get started recapping last week. I saw the S&P trade lower in 4 of the 5 trading days, down about 1.5% on the week, despite was a very strong rally on Thursday that immediately followed some very poor CPI or inflation data. That is not necessarily the reaction we would have expected, especially considering there weren't any other major catalysts outside of a technical indicator that had suggested a buy signal. Then we saw that trend reverse on Friday. Market gave back all the gains, got us back to where we were pre-CPI, which we actually used as an opportunity to slightly increase the equity allocation back to neutral. I'll talk about that in just a minute. But as we digest the CPI report, both the headline and the stickier core inflation were up, the latter up at 40-year highs. Not surprisingly, that then pulled interest rates higher. Again, the Fed's response to combating high inflation is raising interest rates. We saw the 2-year yield on a Treasury bond close the week near 4.5%. Again, just to put the magnitude of these moves in context, January 1st of this year, market expected that the terminal rate or the interest rate where the Fed stopped hiking would be 2.8. So again, already 50% beyond what the market had initially expected. Obviously, that was in response to what has been truly historic and very sticky inflation. I think that all but locks in a 75 basis point rate hike in November, likely get another 50 basis points in December. So again, expect interest rates continue to march higher here in response to what has been a very stubbornly high inflation rate. Again, that has not yet shown any confirmed signs of peaking. Last week, we also got retail sales data that was flat month over month, up 8% year over year. Keep in mind that's nominal, so that is not adjusted for inflation. When we back out the higher prices, that ultimately translates to a fairly flattish report, mixed interpretation of is that good or bad. Ultimately, I think it confirms something that we already know. Global growth is slowing on a real or inflation adjusted basis. However, not slowing to the point where we're in a recession, at least certainly not yet. Obviously, things could change down the road, but based on reporting data today, economy is still moving along, just not necessarily at the same clip we once were. The other piece, last week, we saw Q3 earnings kick off. That's where every quarter we get to hear from corporate executives talk about how they did, provide an outlook for what the road ahead looks like. I've heard from about 7% of the S&P 500 companies thus far. 2/3 of them have actually outperformed or exceeded analyst expectations. Certainly that could be viewed as an encouraging sign, although keep in mind that was a very low hurdle or bar to clear. That being said, though, obviously exceeding a low hurdle still beats underperforming it. So good news there. What we are hearing from corporate executives, one is that are starting to see a minor improvement with respect to labor costs, not necessarily to the degree that the Fed is probably looking for, but have started to see some improvement there as well, confirming a trend that we heard through that retail sales report that the U.S. consumer, by and large, is doing okay. Again, they are still going out, they are still spending, they are still traveling. That was confirmed through hearing from a lot of banks that typically kick off the earnings season. Turning overseas, we had some turnover in the British leadership that was following some somewhat questionable decisions with respect to policy. Obviously, the market does not like uncertainty, particularly when people are in leadership roles. However, when you think about the strong start to this week, market has clearly got comfortable with the individuals in those seats going forward. Also, we did get a very fiery speech from the Chinese president during their equivalent of the State of the Union. Granted, they do this once every 5 years. Had somewhat of a nationalistic tone to it that probably does not do anything to necessarily improve U.S.-Chinese relations. Not that that was going to be a major market-moving event. What would have been if they had announced any changes with respect to their zero COVID policy. We did not, unfortunately, hear that, but certainly something continued to monitor. China being the second largest global economy, where they have shut down their cities in response to COVID outbreaks, that has certainly weighed on global growth. And then transitioning, as I talked at the start of the call, use the volatility on Friday to actually increase our equity allocation, bring that back to neutral in our tactical portfolios. By and large, we had been underweight risk for the last several months. That was in anticipation of additional volatility. And at this point, I believe there's probably an equal probability, of a 5 to 10% movement, either up or down. But when we take a step back from sort of 30,000 feet, the average bear market stocks pull back 32%. We were within a few percentage points of that. All the while, we've been talking about how if we did go into recession, this would likely be shallower. That was based on the strength, of the U.S. consumer, the strength of corporate balance sheets and profit margins. And so we were within a few percentage points of that average bear market low. Again, certainly want to acknowledge the fact stocks could trade lower here over the short intermediate term, but based on the probability of equal movements up or down, with longer term, more potential to the upside, I felt like this was an attractive opportunity, get those equity allocations back to neutral, but still favoring, those more attractive segments of the market, companies that have stronger earnings, more sustainable earnings, higher free cash flow, as well as strong balance sheets, companies that aren't going to have to refinance maturing debt at what are now obviously significantly higher interest rates. And as we think about that broader term, folks with a somewhat multi-year time horizon, the catalysts to move the market meaningfully from here do believe are biased to the upside. Again, we think about at some point inflation will peak, will start to trend in the right direction. That will likely allow the Fed to pause their interest rate hiking campaign, reassess the direction of inflation at some point, expect them to pivot or actually to cut interest rates. I think both of those would have a positive impact on risk assets. Make no mistake, the Fed does not want to be maintain their very restrictive high interest rate mandate. They want to be able to foster growth, just not at the expense of inflation. And so at some point when we do see meaningful progress there, to absolutely anticipate we will see the Fed pivot, likely though not happen overnight or in the time horizon that we would want. Third point there, when we think about Ukraine, there have been reports of continued escalation or fighting. Granted, there were rumors last week of potential ceasefire talks. At some point, have to imagine that conflict will come to an end, and that would certainly be well received by markets. One, not only by reducing the global, geopolitical tensions of a military escalation, but also when you think about the amount of energy and particularly the amount of agriculture that is produced by those two countries, I do believe a ceasefire would open up trade, putting downward pressure on some of those commodity prices. Obviously, that then has a direct positive impact on reducing inflation. And then lastly, fourth key piece we're focused on would be China. And if they do eventually make some shift with respect to their zero COVID policies, as the second largest economy in the world, by shutting down their cities in an effort to try and curb COVID spread, that has obviously had a negative impact on growth. If that situation improves or ultimately there's a shift in policy, do you think that would be a positive catalyst for global growth and risk assets as well? But that's all for now. As always, happy to discuss any of this in more detail. If you don't connect, have a great rest of the week. Take care.